So, United Health Group just closed out a really difficult 2025, and they did it by making a very decisive choice to take a pretty significant one-time financial hit. The goal here wasn't just to close the books, it was to completely reset the foundation for the entire company going forward.
Okay, let's get into what that means. The company took a $1.6 billion net charge. Now, this is what you'd call the noise. It's a one-off event that's meant to be separated from the core business. It's made up of a few key things: a final adjustment for the cyber attack costs, a little bit of a net gain from selling some assets they didn't want, and then a much larger piece for some broad restructuring. This was them just clearing the decks all at once.
And this is where you have to pay attention to management's language, because this is the core signal. They kept repeating that this charge was all about setting a solid foundation. That kind of phrasing tells you that they saw this pain as a necessary price to pay to get back to the kind of predictable, high-quality earnings that everyone expects from them.
Now, a reset this big has a very real, very visible consequence. And here it is: a planned drop of roughly 2.5 million members in 2026. And I want to be clear, this is not an accidental loss. This is a direct outcome of their new strategy. So what we're seeing is a huge shift in how they're thinking about allocating capital. The company is pivoting hard away from that 2025 mindset of growth at all costs. Now, for 2026, it's all about margin recovery. They are very actively choosing to be more profitable over just being bigger in certain markets. And this right here shows you the payoff for that trade-off. That big drop in membership is what allows them to get an estimated 40 basis point improvement in operating margins for their main insurance business, United Healthcare. That's the tangible financial gain that makes the whole strategy make sense. And if we dig a little deeper, we can see exactly where those membership cuts are happening. The biggest piece, about 1.3 million, is coming out of Medicare Advantage. That's a direct result of them repricing their plans to actually reflect the true costs. Another big chunk is from Medicaid, which is being driven by some state funding issues and them just exiting a market. And again, let's just zero in on how consistent management was with their messaging. They kept framing this as intentionally right-sizing the business. The goal here is to focus on serving the members where they can actually have a sustainable, profitable relationship, instead of just chasing market share for the sake of it. This same disciplined approach is being applied to the services side of the company too. Optum is going through its own major overhaul. They're moving away from a period where they expanded really fast, sometimes inconsistently, and they're getting back to their core principles. And the actions they're taking are very concrete, very aggressive. Optum is shrinking its affiliated doctor network by almost 20% to get better alignment. It's cutting its risk-based membership by 15%, basically dropping contracts that weren't making money. And this one's huge. It's consolidating from 18 different electronic medical record systems down to just 3. That's a massive move toward being more consistent. The endgame for Optum is crystal clear. All of these moves are designed to do one thing: create a more stable, more predictable business. They want to drive consistency in how they do things, create clearer lines of accountability, and at the end of the day, just improve their financial performance. So, with the foundation reset, the focus is now turning to the future. The company is putting some serious capital to work, almost $1.5 billion in 2026 alone, into technology and artificial intelligence. This is a huge strategic investment in their future growth and their ability to become more efficient.
Now, what's really important here is this idea of operating leverage. By investing a ton of money into scalable platforms like AI, the company is trying to build a much more efficient cost structure. The goal is pretty simple. As their revenues grow down the line, they want their profits to grow even faster.
And we're already seeing the short-term impact of this. United Healthcare is expecting to cut almost $1 billion in operating costs in 2026, and a big chunk of that is coming directly from AI. This is a direct boost to the efficiency of the insurance business.
So the path for 2026 is laid out pretty clearly. It's going to be a year of stabilization. Most of the earnings will come in the first half. Then, as the business finds its footing, the plan is to get back to their normal ways of deploying capital and really strengthen the balance sheet, aiming for a 40% debt-to-capital ratio by the end of the year. And all of this culminates in the official guidance for 2026. The company is projecting revenues around $440 billion and adjusted earnings per share of over $17.75. That represents growth of at least 8.6%. This is the financial outcome they expect from this whole reset. So when you take all of this into account, the strategic clarity they've shown, the decisive actions to fix the cost base, and the big investment in future efficiency, the outlook has materially improved. Now, there's still execution risk, of course, but the company has created far more strategic optionality for itself in the years ahead. The overall quality of this reset and the clarity they've provided warrants a score of 7.5 out of 10.